Here is a number most Canadians have never calculated. If you earn $70,000 in Ontario, the amount you pay in combined federal tax, provincial tax, CPP, and EI in 2026 is approximately $17,600 per year. That is $1,467 per month, leaving your paycheck before you buy a single thing. But that is only the beginning. Because income tax is not the only tax Canadians pay. Add the 13% HST you pay on most goods and services in Ontario. Add the carbon tax, currently approximately $95 per ton on fuel. Add property tax, averaging approximately $4,500 to $5,500 per year on a median Ontario home. Add gas tax, land transfer tax, tobacco tax, alcohol tax, import duties embedded in the price of goods. The Fraser Institute's annual study consistently estimates that the total tax burden on the average Canadian family, including all visible and hidden taxes, consumes between 40% and 45% of total household income. 4 in $10. Gone. And yet, most Canadians could not name the 5 federal income tax brackets. Most could not explain the difference between their marginal rate and their effective rate. Most have never used the legal strategies available to every Canadian that can reduce their tax bill by thousands of dollars every year. This video changes that. By the end of it, you will understand exactly how Canadian taxes work, where your money actually goes, why the same $100,000 salary produces dramatically different tax bills depending on where you live, and 5 completely legal moves that reduce what you owe. Before the numbers, let's destroy the single most common tax misconception in Canada. Most Canadians believe that if they get a raise that pushes them into a higher tax bracket, they suddenly pay more tax on their entire income. This belief causes real financial harm. People turn down raises. People avoid overtime. People make decisions based on a tax myth. Here is the truth. Canada uses a graduated progressive tax system. You pay the lower rate on every dollar up to the threshold, and only the higher rate on dollars above it. Your whole income never moves into a higher bracket. Only the portion above each threshold does. Here are the 2026 federal income tax brackets confirmed by the CRA. The basic personal amount for 2026 is $16,129, meaning the first $16,129 of income is effectively tax-free at the federal level for all Canadians. Here is the critical distinction every Canadian needs to understand. Marginal rate. The rate you pay on your next dollar of income. If you earn $70,000 in Ontario, your federal marginal rate is 20.5% because the next dollar you earn falls in the second bracket. Effective rate. The actual percentage of your total income paid in tax. At $70,000 in Ontario, your combined effective rate after all deductions is approximately 25%, significantly lower than the marginal rate. The marginal rate is what matters for decisions about RRSPs, deductions, and income splitting. The effective rate is what matters for understanding your real tax burden. On top of federal tax, every province adds its own income tax. Ontario adds 5.05% to 13.16%. Alberta adds 8% to 15%. Quebec adds 14% to 25.75%. British Columbia adds 5.06% to 20.5%. Your action step: calculate your own marginal rate right now. Find your income on the federal bracket table. Then find your province's matching bracket. Add the two together. That combined marginal rate is what every RRSP dollar you contribute saves you. immediately. Here is the most shocking comparison in Canadian personal taxation, and it directly affects every Canadian who has ever considered moving provinces. The same $100,000 salary produces dramatically different after-tax income depending entirely on which province you live in on December 31st. Here is the 2026 combined federal and provincial tax bill on exactly $100,000 in employment income across Canada's major provinces, including income tax, CPP, and EI. At $100,000, an Albertan takes home approximately $2,200 more than an Ontarian and approximately $6,700 more than a Quebecer every single year, without earning a single dollar more. Over 30 years, that $6,700 annual difference invested at 8% annual return equals approximately $820,000 in additional wealth from the same salary, just by living in a different province. Alberta's tax advantage comes from two sources. First, a flat 10% provincial income tax rate, rising to 15% only at very high incomes, the lowest in Canada for most earners. Second, no provincial sales tax. While Ontario, BC, and the Atlantic provinces charge combined HST of 13% to 15%, Alberta charges only the federal 5% GST. Quebec offers the most extensive provincial services, funded by the highest provincial income tax rates. Its top combined marginal rate reaches approximately 53.31% at the highest income levels. Ontario's top combined rate reaches approximately 53.53%. Nova Scotia reaches 54%, the highest combined rate in Canada. The province you live in is one of the most significant financial variables in your entire life. Yet most Canadians have never calculated how much it costs or saves them annually. Your action step: calculate your province's total tax bill on your current income using the KPMG Personal Tax Calculator. Free online. Then calculate what the same income would produce in Alberta. The difference is the annual cost of provincial choice. Income tax is the most visible tax Canadians pay, but it is far from the only one. Here is the complete picture of the taxes embedded in everyday Canadian life, most of which Canadians pay without ever seeing a separate bill. The goods and services tax and harmonized sales tax. The federal GST is 5% on most goods and services. In Ontario, BC, New Brunswick, Nova Scotia, Newfoundland, and PEI, it is harmonized with the provincial sales tax into a combined HST of 13% to 15%. Every coffee, every haircut, every Netflix subscription, every car repair bill, 13% to 15% of that spending goes directly to government. On $30,000 in annual taxable spending, a 13% HST represents $3,900 per year in consumption tax. This is paid invisibly, embedded in every price, every single day. The carbon tax. Canada's federal carbon pricing system currently sits at approximately $95 per ton of CO2 in 2026. After the Carney government paused consumer carbon pricing on home heating oil and then restructured elements of the consumer carbon levy. The carbon levy is embedded in the price of gasoline, natural gas for home heating, and other fossil fuels. The average Canadian household pays several $100s per year in direct and indirect carbon costs, partially offset by the Canada Carbon Rebate. The CPP and EI payroll taxes. These are not income taxes, but they function as mandatory payroll deductions that reduce take-home pay. CPP in 2026, 5.95% on earnings between $3,500 and $71,300. Maximum $4,034 per year. Enhanced CPP 2. An additional 4% on earnings between $71,300 and $81,900. Maximum $428 per year. EI. $1.64 per $100 of insurable earnings up to $65,700. Maximum $1,078 per year. Combined CPP and EI maximum in 2026, approximately $5,540 per year for a median earner. That is $5,540 that never appears in your bank account, deducted automatically before your paycheck is issued. Property tax. The average Canadian homeowner pays approximately $3,500 to $6,000 per year in property tax, depending on municipality. Toronto homeowners paid an average of approximately $4,500 to $5,500 in 2025. Vancouver homeowners pay lower rates on higher assessed values. Calgary homeowners benefit from Alberta's relatively low municipal mill rates. Property tax is paid on an asset you already own, with money you have already paid income tax on, at rates set by municipal governments with limited accountability to provincial or federal oversight. The cumulative burden. Add income tax, $17,600 at $70,000 Ontario, plus HST on spending, $3,900, plus CPP plus EI, $5,112 at $70,000, plus property tax, $5,000 if homeowner, and the total annual tax burden approaches $31,612 per year on a $70,000 Ontario income. That is approximately 45% of gross income going to various levels of government. Here is the knowledge that most Canadians earning above $70,000 have never been clearly taught, and it directly affects every investment decision they make. Not all income is taxed the same way. The tax system treats 4 different types of income at 4 dramatically different rates. Understanding this is the foundation of legal tax minimization. Employment income, taxed at full marginal rate. Salary, wages, and most employment income is taxed at your full combined marginal rate. At $100,000 Ontario income, that is approximately 43.41% on the next dollar earned. This is the least tax-efficient form of income in Canada. Interest income, taxed at full marginal rate. Interest from savings accounts, GICs and bonds, is taxed at the same rate as employment income, fully included in taxable income. This is why holding GICs and HISAs inside a TFSA, where interest is tax-free, is so important. Outside a TFSA, fully taxed. Inside a TFSA, zero tax. Eligible dividends, taxed at significantly lower rates. Dividends from Canadian public corporations receive the dividend tax credit, which recognizes that corporate tax has already been paid on the income. At $70,000 Ontario income, eligible dividends are taxed at approximately 7.6% combined. At $50,000, effectively near zero in some scenarios, compared to the 26% combined marginal rate on employment income at $70,000. Eligible dividends at 7.6% represent an 18 percentage point tax advantage per dollar of income. Capital gains, 50% inclusion rate. When you sell an investment for more than you paid, the profit is a capital gain. In Canada, only 50% of the capital gain is included in taxable income. The other 50% is completely exempt. At $100,000 Ontario income, the effective capital gains tax rate is approximately 26.76% combined, roughly half the employment income rate on the same dollar amount. This is the structural tax advantage that makes TFSA investing so extraordinarily powerful. Inside a TFSA, capital gains are taxed at 0%, not 26.76%, not 50% inclusion. 0. Every dollar of growth stays entirely with the investor. The practical implication, for a Canadian investor, the sequence of tax efficiency from best to worst is TFSA, capital gains and dividends, 0%. Eligible dividends in taxable account, approximately 7.6% at $70,000 Ontario. Capital gains in taxable account, approximately 26.76% effective at top Ontario rate. Interest income, approximately 29.65% at $70,000 Ontario. Employment income, approximately 43.41% at $100,000 Ontario. Building wealth inside a TFSA first maximizes the most tax-efficient vehicle. Building wealth through equity investments, capital gains plus dividends, rather than interest-bearing products in taxable accounts, improves tax efficiency on every dollar. Here are the 5 completely legal moves that reduce your Canadian tax bill. Every one of them built directly into the tax code by the government. Using them is not avoiding taxes. It is using the system exactly as intended. Move 1. Max your TFSA every year. The TFSA is the single most powerful tax reduction tool available to every Canadian. $7,000 per year in 2026. All growth, capital gains, dividends, interest, completely tax-free forever. Every dollar of investment income generated inside a TFSA is income that will never appear on a T1 return and will never be taxed, at any rate. Over a 30-year investing horizon, the tax saving inside a TFSA on a fully invested portfolio can reach hundreds of thousands of dollars. Move 2. Contribute to your RRSP at your marginal rate. Every dollar contributed to an RRSP reduces your taxable income by exactly that dollar, generating a refund at your marginal rate. At $70,000 Ontario income, a $10,000 RRSP contribution generates approximately $2,965 back immediately. At $100,000, approximately $4,341 back. The 2026 RRSP contribution limit is $32,490 or 18% of prior year earned income, whichever is less. At $100,000 income, your limit is $18,000. Contributing the maximum generates approximately $7,814 in tax refunds at the combined Ontario marginal rate. Reinvest every refund immediately into your TFSA. The compound effect of the RRSP refund loop, over 30 years, adds hundreds of thousands to the final portfolio. Move 3. Open an FHSA if you are a first-time buyer. The First Home Savings Account is the most underused registered account in Canada. $8,000 per year. $40,000 lifetime. Contributions are tax-deductible like an RRSP. Withdrawals for a qualifying home purchase are tax-free like a TFSA. At $70,000. Ontario income. An $8,000 FHSA contribution generates approximately $2,372 in immediate tax refunds. Over 5 years of maximum contributions. $40,000 contributed plus approximately $11,860 in refunds equals $51,860 toward your down payment with government money helping build it. Move 4. Claim every tax credit you are entitled to. The CRA offers dozens of non-refundable and refundable tax credits that most Canadians never claim or underclaim. Basic personal amount, $16,129, claimed automatically, but ensure it is applied correctly. Canada Workers. Benefit, refundable credit for lower-income workers, up to $1,518 for single individuals. Child care expense deduction, up to $8,000 per child under 7. Deductible from the lower-income spouse. Medical expense tax credit. Expenses above 3% of net income. Claimable for yourself and dependents. Home buyer's amount, $10,000 first-time buyer credit, generates approximately $1,500 in federal tax reduction. Disability tax credit, significant annual credit for eligible Canadians and their caregivers. Moving expense, deduction, if you moved for work or school, eligible moving costs are deductible. Most Canadians use a basic tax software and claim none of these beyond the automatic credits. A thorough annual review consistently finds $500 to $2,000 in missed credits. Move 5. Split income, where the tax code allows. The Canadian tax code contains several legal income splitting mechanisms that reduce the family unit's total tax bill by moving income from a higher-rate taxpayer to a lower-rate taxpayer. Spousal RRSP, contributing to a spousal RRSP, allows the higher-income partner to claim the deduction today, while the lower-income partner withdraws it in retirement at their lower rate. The lifetime tax saving can reach tens of thousands of dollars. TFSA contributions from the lower-income spouse. Investment income generated inside a TFSA is tax-free, regardless of who contributed the funds, meaning the higher-income spouse can contribute to the lower-income spouse's TFSA without attribution rules applying. Pension income splitting. Canadian couples aged 65 plus can split up to 50% of eligible pension income with a lower-income spouse, reducing the family's total tax bill. Let's come back to where we started. $70,000 Ontario income, $17,600 in combined income tax, CPP, and EI. Add HST on spending. Add property tax if you own. The total annual tax burden approaches $27,500 to $31,600, nearly 40% to 45% of gross income. That number is real, and most of it is unavoidable. But here is what is also real. A $10,000 RRSP contribution at $70,000 Ontario income generates $2,965 back. An $8,000 FHSA contribution generates $2,372 back. A fully maxed TFSA eliminates all future tax on the investment income that would otherwise be taxed at 7.6% to 43.41% every year. A thorough tax credit review recovers $500 to $2,000 in credits most Canadians miss annually. Combined, the 5 moves can reduce your effective annual tax bill by $6,000 to $12,000 per year, depending on income and circumstances. That is not tax avoidance. That is using the registered accounts the government built specifically for this purpose. The tax system in Canada is genuinely heavy, consuming 40% to 45% of a working family's total income when all taxes are counted. It varies dramatically by province. with an $820,000 lifetime wealth difference between the highest and lowest provincial tax burdens on the same $100,000 salary. The system rewards those who understand it. The TFSA, RRSP, and FHSA are not loopholes. They are explicit incentives built into the tax code, designed to encourage saving, investing, and home ownership. The truth about taxes in Canada is this: the burden is heavy, the code is complex, and the advantages are substantial, but only for those who know where to look. Now you know where to look.